Dear colleagues, we are very glad and grateful for you joining the webinar, which is dedicated to the doing business in the United Kingdom. Please put plus or any other symbol that you hear me and see this presentation. In the chat. Colleagues, could you put down anything that you hear me and see the picture? Great, great. Thank you so much. So, it is quite long tradition, which was launched by the Crowe offices in Ukraine and Estonia, of arranging webinars for the our clients in Eastern Europe, Baltic countries, Ukraine, Moldova, Poland, Georgia, Azerbaijan, Asia, dedicated to the issues how to arrange business in every single country. For the last 6 years, we have held around 50 webinars from China to USA, and some countries were our speakers 2 times, where it is important for the changes in the legislation. Currently, I'm very glad to announce that we repeat webinar dedicated to the United Kingdom. As usual, we will touch the questions related to how to incorporate certain structure, what are the regime of taxation, both for companies and for the individuals, and are there any smart advice how to use benefits like existing in the United Kingdom for dividends or for capital gains in course of doing business in this country. Our speakers today, the high-level specialist from the office, Crowe office in the United Kingdom, Divya Ramaya, Ben Carter, Duncan Cleary, and co-moderator of our event, Leonida Giev, who is the head of Crowe in Estonia. As usual, we encourage you to put down questions in our chat. Upon the delivery of the webinar, our speakers, moderators, will revise your questions and arrange questions and answers session. Maybe these are all final or introductory issues which I would like to mention. And I ask Leonid to start and moderate of the reports of Divya, Ben, Duncan.
Thank you so much, Dmitry. Thank you so much. But there's nothing from my side to add currently. Maybe I will give the stage to Divya, who will manage and he will start the presentation.
Brilliant. Thank you. Thank you for the introduction, both of you, and allowing us, the opportunity to present again. We've been here before, like Dmitry mentioned, but it's nice to be able to contribute and provide insights around, what's happening in the UK and how we can support, all of our clients across the globe to do business in the United Kingdom. So welcome to our webinar. So in the webinar today, we will cover, please go into the next slide for me, Daria. So, why a lot of businesses choose the United Kingdom? We will go through that and we'll cover that aspect. What pockets of the United Kingdom do what in terms of different sectors. We will then discuss, what you need to have in place from a formation perspective. There are all sorts of different structures. We'll talk to that, and then we'll touch on the taxes aspect of it. If you have a corporate structure, what are the corporate taxes you need to be mindful of? If you're setting up business and investing in the UK, what you need to be mindful of from a personal tax perspective. So we'll be covering that too. We'll be touching on, what structures we see firsthand. You've got people, businesses investing in the UK, PE, VC-backed businesses investing. You've got individual investing. What popular structures are in place that are being used. We will also cover the practical cases, some good stories, some bad stories, and some testimonials from our clients in the UK who have invested in the United Kingdom. And finally, we will go through any questions that you may have. We'll do our best to cover as much as possible. Next slide, please. So why choose UK? Next, please. Thank you. Despite geopolitical challenges that we're seeing all over the world at the moment, UK continues to be a gateway to, global growth. Within the UK, we have got, Birmingham, which is a regional area that is predominantly known for manufacturing and engineering hubs. You have got Manchester, which is known for digital tech and media and creative industry. And London, of course, is known for, being the global headquarters and, for finance and investor access. So you have got conversations happening. Not to forget that London is obviously the financial district, and we've got quite a lot of professional firms. So from a, choosing UK perspective, the UK continues to have a very good strategic global access because we're positioned very well between the Americas, the Europe, the Asia, and our time zones are very friendly. I mean, we've got clients across, dare I say, the likes of Australia as well. And we balance that equally with our global partners. We have a very good trusted legal and regulatory framework. So we are transparent, and we also have a very business-friendly system. Like many countries, obviously, the setup can be very challenging, and people tend to get a little, anxious and worried about the time frame that it takes to set things up. But this is with all, good sort of ideas and mindsets that the HMRC here, which is the UK tax authorities, want to make sure that they do really good due diligence. The same applies to the banking system. They will be very rigorous KYC, checks on your businesses to make sure that you have a very good starting point. We continue to have a world-class talent. We have a diverse workforce. We have highly skilled workforce in the UK to support any sectors. And the innovation ecosystem is extremely friendly. We have got, video game tax reliefs, that they can provide like sort of incentives. We also have really good R&D tax systems being introduced to support, startups who are looking to scale and invest in any, patented new technology or engineering aspects of the business. Tailored to that, obviously, we have got, investment incentives that the government continue to introduce, and there is a very good, chamber of commerce in the United Kingdom, much like every jurisdiction, that are there to support businesses through all aspects, whether there's inbound or whether they are looking to, come into the UK and then diversify to go into, say, the UAE or, the USA or Pan Asia. There is a lot of guidance available. Just to touch very quickly, within the webinar, we have uploaded our inbound guide. So if any of you, fancy, please do give it a read, because that walks through how, we in the UK support businesses through their life cycle, from startup through growth to exit strategies. It's a very useful material. There are also contacts in there, so please do not hesitate to reach out. Next slide, please. So from a business setup and requirements perspective, next slide, please. The common structures structures and formation vehicles that we see are usually a private limited company. that is a very quick and easy setup. It is available, to set up on a same day basis. If you don't want a same day service, it is a 2 to 3 day turnaround time. It offers a limitation of liability for groups or organizations. From a share capital perspective, you can have a penny share, you can have a pound share, you can have £100. It's not very intensive from a perspective of saying you need to have £100,000 being injected into a company, and that's a requirement. The UK company formation is very simple. They are obviously going to be with any other, vehicle, regulatory filings that will be required. The Companies House require you to have annual, confirmation statements that need to be lodged. You will have to file statutory accounts. Depending on how big your business is or how big your group is, there may be a requirement for audit. For the UK company, regardless of how small the UK may be. And with any other business, the regulatory filings will come in regards to sales tax, value-added tax, corporation tax, payroll. Pension is a mandatory pension provision in the UK. Because you're a business, as with any other business, you will be required to have employer liability insurances and also make sure that you have the GDPR registrations in place, not forgetting that if you have a workforce, you may need to think about health and safety and others depending on the sectors, because every sector will have different prerequisites. The other formation vehicle that we tend to see is branch. Now, the difference between a company and a branch, for a company, businesses tend to go down the company route if they know that they're going to have a growth trajectory in the UK. Branches are very common when businesses are uncertain as to what they want to do in the UK and they're just tapping the market. They set the branch up because it's very easy to just wind things up from a branch perspective and go, we're sending one person into the UK to just assess the market, do the due diligence, but that person is going to be there and is going to support us. So, branch, it obviously doesn't provide you with a limitation of liability scenario because it is directly an arm of the parent company wherever you may be. But if you're looking to be permanent in the UK and have a growth trajectory, companies usually, the preferred, method that people lean towards. Branch takes a little longer to set up, can take up to 2 weeks and longer, depending on how, what sort of information you have available and if you've got all of the documents available, because quite a lot of the filing information that goes on the UK company registrar would be information about the foreign establishments. So for instance, if you have a Ukrainian business, there'll be quite a lot of information about the directors and the business in Ukraine that needs to be provided. The branch is a paper filing, so hence it takes longer, and it's very subjective to companies' house's permission. They may seek additional information, but we are very, very well placed to support you with that. So if you do ever need that, we can guide you through the process. So the overseas companies accounts, from a branch perspective, branch doesn't need to file statutory accounts in the UK. However, unlike the Companies House requires the foreign entity, for example, the company in Ukraine, to file English translated financial statements. So from a competitor's perspective, it is the Ukraine's business statistics and data and operation details that will be filed on the UK governing, website, the company registrar. In terms of the regulatory filings, the difference between the UK company, private limited company, and the branch is everything is similar, except you won't have audit in the branch and the statutory accounts are not required. However, management accounts or unaudited statutory financial statements will be required for tax filing because that is required to be filed along with the tax returns in the UK. The other, model that people tend to use is a limited liability partnership route, which is where you have got a group of individuals, much like Crowe UK are. We are limited liability partners. You will have a number of partners that come together, set up a business and want to make sure that, they run the business as a partnership, so they have profit shares and everything. Within that, you can either have an individual partner like sort of model, or you can have individual and corporate partners, designated partners model. Do bear in mind that if you have a LLP arrangement, individuals will have their own personal tax filings to do from a self-assessment perspective. And if you have a corporate partner, for instance, you have a UK limited company also being a corporate partner of the limited liability partnership, the corporate partner will have its own filing requirements as well. So from a regulatory filing perspective, other than the points that I just mentioned about corporate partners having its own, filing requirements and individual partners having its own filing requirements, everything else is very similar to company, VAT, payroll, pension, GDPR, health and safety. If you have a workforce, all of that becomes a mandatory regulatory filing for you. Much like many jurisdictions, banks tends to be a challenge. And I mentioned earlier that, KYC, knowing your clients, and onboarding is highly regulated, in whether you're appointing law firms, whether you're appointing professional firms like ours, or whether you're appointing banks. Every business will have to go through KYC. It's very useful to have all of those documents ready. From a banking perspective, depending on which bank you go with, the time frame is usually around 4 to 6 months. Now, each UK bank is different, and their filing and KYC onboarding will be slightly different. There are nuances around it. However, the overarching view that they need to have proper KYC checks done are extremely important. So do bear that in mind. Also, depending on the size of your business, if you're a small company, bankings tend to say the corporate head will not handle you. So you will need to go through High Street Bank, which is an online application. And quite a lot of the front loading and the paperwork and applications is done by the clients. We can guide you, but unfortunately, the only support that you really have is very much online. So please do bear that in mind. It is quite different for medium and large size organizations. You'll have law firms or professional firms like ours who will have significant contacts or a pool of contacts that they can leverage to say, we've got this client, they're going to be turning over above 2 million in the UK, and they need a bank account now pronto because they're setting up business and going live. We can leverage other contacts and they'll be able to set that up. Again, they are also very much tied on their KYC and onboarding. So time frame will be in the region of 4 to 6 months. So please bear that in mind as well. So I mentioned earlier, banks are highly regulated. In the UK, from a company formation perspective, we now have a mandatory, verification of persons with significant control that is required. And that also becomes very important from a banking perspective. Now, where businesses do not have credit history, and it's quite common because we support quite a lot of inbound businesses that are entering in the UK for the first time, and they have no credit history. There is another route where if you don't go with a traditional high street bank or a corporate bank, the other route is going down the route of challenger banks, the likes of Revolut, Metro, and also, Starlink. There are loads of other banks that provide challenger banks. Obviously, their insurance is limited from a protection perspective. So what we tend to do in terms of advising clients is go with, small value transactions flowing through those bank accounts to begin with until you have your credit history, and then you can switch to a traditional high street bank or a corporate bank when you're sizable. So from a compliance registration perspective, VAT registrations, these can take 4 to 10 weeks. VAT is voluntary if your taxable supplies are below 90,000 per annum. We encourage businesses to register for VAT because you will be incurring legal fees, you will be incurring professional fees, and you will be charged VAT on your invoices if you're a company or a branch or LLP registered in the UK. So in order to claim that, we would recommend that you do register. So you're allowed to register on a voluntary basis. Obviously, do bear in mind that if you have businesses that are in the financial services, or if you've got any sort of specific trades, there will be some element of partial exemption depending on what sector you're in. So VAT reclaim can be limited. Payroll is very easy. It can take 3 to 5 working days. Preferably, registration is done 1 month before the first payday. So payroll is not a nuance from a registration perspective. However, do bear in mind that when you do offer pension, mandatory pension in the UK, you are required to provide a UK bank account for registration. Now, some professional firms, law firms, accountants like ourselves, will be able to provide Crowe trust accounts or client trust accounts that you could use in the interim, which will be a UK bank account, but that cannot be used for operations. It's purely for taxes and for registrations and helping with your payroll and pension requirements. It's a short-term fix. Clients tend to use that for a year and a half until business is running, and then they move on. Corporation tax registration and the tax reference number gets automatically issued when a company or a branch or a LLP is registered. However, advisors like Ben and Duncan, my colleagues on the call, will need to do things behind the scene to make sure that they are informing HMRC around what the business is going to be doing, what sort of turnover it will be, and making sure it's set up correctly as an agent for you, which can take about 2 to 4 weeks to sort out for you. Now, a small nuance in the UK, every tax registration has a different unique number. Company will have a different number. Your employment taxes will have a different number. Your corporation tax will have a different number. And, if you are an LLP and a partnership, will be a different number, including VAT. So every tax has a different VAT number. It doesn't go under one tax system. Because in the UK, our different tax aspects in the tax authorities do not yet operate from a single number, unlike some jurisdictions. Next slide, please. Ben, this is yours. Over to you.
Yeah, thanks, Divya. So I'm now just going to touch on some kind of residency things to be aware of from an entity perspective. So the first thing to consider is central management and control. And the first point to highlight is that it's not just where the company is incorporated that's relevant for this purpose. It's also where the activity is carried out. And from HMRC's perspective, they will tend to look at the highest level of control. So they're not really interested in the more sort of mundane day-to-day operations. They're going to be looking at where decisions are being made and who's carrying those out. One of the points here to consider is the board meetings. It's not entirely relevant all the time where they're carried out. For example, these might be taking place outside the UK, but the key decisions are actually being made in the UK, and effectively the overseas individuals are just rubber stamping the decisions. That's something that HMRC would look through and determine probably that it's actually UK activity that's being carried out. And it's not just the board meetings either as well. It could be a parent company, or it could be a shareholder, if they're the ones that are making the big decisions. And I think the key thing to try and avoid is the entity being resident in more than one jurisdiction. So, for example, if you've got a company that's the authorities believe is resident in the Ukraine and the UK, it can get a bit messy. You end up needing to look at the treaty tiebreaker clauses, and if that can be avoided, then that is the ideal position to be in. Particularly if you've got both jurisdictions fighting to suggest that the company is resident in their jurisdiction, it can get quite messy, and it can also be quite time consuming. Another thing then to consider is permanent establishment in the UK. And there's two main ways this is considered. So there's a fixed place of business in the UK, or there may also be what we call a dependent agent operating in the UK on behalf of the overseas company. For the fixed place of business, usually what we see is a specific geographical point. So there might be, an office in London, for example, and also a degree of permanence. Short and temporary presence is less likely to create a permanent establishment. But if that is reoccurring and happens quite regularly, then that could also trigger a permanent establishment issue in the UK. On the dependent agency point, HMRC have widened the rules from January of this year onwards. In the past, it used to be if there was an individual who had authority to conclude contracts in the UK on behalf of the overseas entity and regularly did this, then that would create a permanent establishment. But what they're saying now is actually if the individual is playing a key role in creating those contracts, and essentially those contracts are not really changing when they're being signed off outside the UK, then that now could also be enough to trigger a permanent establishment issue in the UK. So the key point is understanding where your people are, where they're operating, and what they're up to. I think it's really important to understand if you've got someone operating outside the main jurisdiction of the company, you've got some clear policies in place as to what they can and can't do to make sure that you don't create this permanent establishment. And the other thing that HMRC will consider as well is around directors. So it's not necessarily where that individual is tax resident. They're also going to be looking at where they are exercising the control. So, a few board meetings here and there or a short period of UK presence will not necessarily create a permanent establishment, but regular UK decision making by the directors would again lead to an increased risk that a permanent establishment is being created. And this kind of leads on to the idea of real substance. So from HMRC's perspective, they want to really understand who really runs the business and where they're running it from. So whilst they will start with looking at the sort of the legal form of the business and what any legal documents may say, they have the ability to look through that to determine what's actually happening. So they'll want to understand where the business is actually present and where the decisions are being made. And HMRC have a fairly useful example that they refer to, which is comparing a company in one jurisdiction to another. So in one jurisdiction, they say they have what they call a brass plate. So essentially the name on a building somewhere against another jurisdiction where they've got employees, they've got premises and genuine business activity. And that will be highly persuasive in understanding the residency position for the entity. So I think the key point here is having good governance in place, making sure proper minutes are being kept of meetings, where those meetings are being held, and the same for decisions as well, understanding where the decisions are being made and keep a good record of those. If HMRC are going to query the position, those are the kind of details they'll want to be looking at. So I think the key takeaway from this section here is just understanding what HMRC will look for. They'll look through the form of the company and they'll look at the facts of what is actually happening, where are the real decisions being made, where is the business carried on, and does the structure have genuine commercial substance as well? I'm going to hand over to Duncan now, who's going to touch on some of the residency and the tax rules in the UK.
Thank you, Ben. Can we go on to the next slide, please? Thank you very much. So just a bit of an overview, as Ben said. Thank you very much for that. I'm just going to touch on some of the points that sort of Divya and Ben have mentioned. And we're going to sort of do a bit of a whistle-stop tour through the corporation tax regime, employment tax regimes, income tax regimes, and then the key one really here is our detailed intricacies of our tax residency rules, which are slightly more complex than most other jurisdictions. So we'll start with the corporate tax section, please. Can you go into the next slide? So I thought it'd be useful just to give a bit of a high-level overview of our corporation tax system and show it side by side so people can really see the comparatives of the two jurisdictions. Firstly, as Divya mentioned, there is an obligation for companies to file their annual returns at Companies House, and these need to be done 9 months and a day after the year end. And similarly with their corporation tax returns, you have autonomy in terms of when you want your year end to actually be, but logically most people will do it on a either a calendar year basis or in the UK normally to a 31st of March year ending date. So as you can see on the screen here, our corporation tax rates over the last couple of years have slowly crept up. So we now have a main rate of tax at 25% for companies who are making profits over 250,000. This is, as I said, it's crept up. It was sort of 19%, 20%, and it seems to be increasing almost by the year at this moment in time. But there is any rumours at the moment of it further increasing. We also have a small profits and a sort of blended profit rate. So for certain companies who don't meet certain thresholds in terms of profit, they can only pay at 19% or end up, if you're in between those sort of marginal 200,000 levels of profit, there's a bit of a sliding scale as to what tax you then would pay on. Similarly to the Ukraine, you know, we have a tax basis where everything is taxed on a worldwide basis, looking at your profits. And then obviously we have but in terms of in the UK now, we don't have any withholding tax on any dividends, which is quite unique compared to quite a lot of jurisdictions that we often see. One thing I really wanted to point out was, although looking at the employment taxes when doing the research for this, is in the UK, we have what we call employment taxes, and they're called national insurance. So they're effectively social securities. So we don't have any caps. So we have a very small de minimis of about £6,000 where there's no employer's national insurance, but then there's a 15% charge on that amount and it's completely uncapped. So it can be really expensive to take salaries out. As with other jurisdictions, we have extensive tax treaties with other countries, including one with Ukraine. Can I get the next slide, please? So yeah, I sort of touched on employment taxes. So in the UK, we have what's called the pay-as-you-earn system. It's done in real-time information. So HMRC are aware of salaried payments and benefits sort of as they arise. And there is an obligation for the employer to operate under the relevant PAYE scheme. Each individual, when they come to the UK, will end up with their own tax code depending on their levels of earnings, and HMRC calculate the appropriate withholding taxes for you as an individual, but then also, as I mentioned, in terms of from an employer's perspective. So in addition to employers' national insurance, we also have employees' national insurance. Again, this figure is uncapped and it's at a low rate of 8% up to about 50,000, but then it's 2% thereafter. And in terms of then, that's sort of the social security element, but then tax on salary, and I'm going to touch on this in a bit more detail on the next slide. But you know, as you can see on the screen there, our highest rate of income tax currently is at 45%. And then when you take into account your national insurance, you know, a salary at a certain level can be paying tax at 47%. But then we also have, which is unique, I've not seen this in any other country, where we have this system where every individual will get a tax-free personal allowance of £12,570. But if your income ends up being between 100 and 125,000, you end up losing £1 of tax-free allowance for every £2 you earn over that figure. So you end up in a blended rate of about 60% tax. So Ben and I and other members in our team, when we're looking at sort of owner-managed businesses, we help them to control their remuneration to avoid that sort of nasty tax trap. So you might have a few years where you keep it below your 100,000, and then one year you exceed it, so you avoid paying that large rate of marginal tax. Can I get the next slide, please? So, I mean, this slide, as you can probably see, with the different sources of income that we have so many different tax rates in the UK, and these are ever changing. So I touched upon income tax rates in terms of our, you know, we have our standard basic rates at 20%, higher rates at 40%, and then 45% thereafter. Interest income is taxed under the same rules. However, from April 27, these are also going to be taxed at an additional 2%. And rental income is also going to follow the same as interest income. So they're almost introducing a faux national insurance charge on interest and rental income that they never had previously. I touched upon the social securities for employees, but I wanted to mention if you were self-employed or a member of an LLP, the national insurance difference is slightly less, so slightly more beneficial, is that at the basic rate of tax, you're only paying at 6% as opposed to at 8%. Tax on dividends in an individual's hands. So every individual gets a tax-free dividend allowance of £500. So when this was introduced in 2016, it was at £5,000. So it's been slowly decreasing. And ironically, the rates have also been increasing. So from April 26, the dividend rate of tax also went up by 2 percentage points. So the Labour government have been slowly sort of increasing these taxes over the last couple of years. I think the one rate, when you just look at these high level figures, you know, the UK clearly is a higher tax rate than what you're currently suffering in the Ukraine. But the capital gains tax element is fairly similar from that perspective. So for people earning less than £50,000, their marginal rate of capital gains tax is only at 18%, and that could be on shares or residential property. And then for higher and additional rates, it's at 24%. One of the other big changes that we've seen is that there's a lot of private equity investment going on throughout the world, and individuals who participate in carried interest. we've introduced it, we've moved it away from a capital gains tax regime to an income tax based regime from April 26. So the rates are significantly higher than what they were in previous years. So we have this new blended rate where, to encourage longer term holding of some of these interests, is if you hold it for longer than 40 months, you end up with a blended tax rate. How they came up with 34.075%, we'll never know, but that's the blended rate that they've come up with. And then if you hold it for a shorter period of time, it's at 47%. So again, our tax rates are very, very high and fairly aggressive, and they seem to be moving in one direction at this moment in time. But there is some relief for some individuals, and I'll touch upon those in the next couple of slides. Can I get the next slide, please? Thank you. So in terms of that, was a bit of a whistle-stop tour of our tax rates and system as such, but I think one of the key things here is to really consider the complexities of our residency test. So I appreciate in other countries, their residency position is sort of fact-based, based on days. It's quite conclusive. There's normally quite a black and white answer, whereas the UK's residency system is very complicated. So I think the first thing to always bear in mind is our UK tax year runs from the 6th of April to the following 5th of April. So our tax return deadline is then the 31st of January following that period. When I'm going to talk about days in this next couple of sections, I'm referring to a day as being present in the UK at midnight. So if, for example, you flew in from Kiev and you landed at 10 o'clock in the morning, and then you got the 10 p.m. flight out of London, that would not be considered as a day in the UK. For our counting purposes, there is some caveats to that. So then when you look through our prescribed tests, we look through, so sort of our first test is automatic overseas tests. So they're pretty conclusive in terms of if you spend less than 16 days here, you're not resident. On the flip side of test 2 is, okay, are you automatically UK resident? If you spend more than 183 days here, you're automatically resident. And there is some other tests, but they're quite conclusive. The one sort of intricacy that we really have that does differ to a lot of countries is the sufficient ties tests. So depending on your ties and connections to the UK, both from a social and economic perspective, it then indicates how many number of days you can then spend in the UK. So for individuals who have limited or low ties to the UK, they can spend slightly longer here without triggering residency. Whereas if you meet more of the ties, you're more likely to become UK resident. So the ties that we have is family ties. So this family tie is obviously spouse or minor children, which is defined effectively as in children under the age of 18. Accommodation is effectively accommodation that is available to you. So this could be through a property that you own, property that you rent, or in some extreme circumstances, it can be a hotel if you stay there too often in the same room and leave things there. In terms of work, the definition of work is basically working for at least 3 hours per day. So if you did, 2 hours and 59 minutes, you'd be fine. But if you exceed that 3-hour threshold, it's considered as a day's work. So you can do up to 40 days of work in the UK without triggering that tie. The 90-day tie is a look back. So you look for your previous 2 tax years. Did I spend more than 90 days in the UK in one of those 2 years? I then have the tie. And then the other tie is the country tie. So have I spent more time in the UK than any other? And then that would then trigger a tie. But if you go on to the next slide, I can talk through in a bit more detail how these ties work in terms of residency position. Thank you. So on the left-hand side, so if you're considering coming to the UK and you've never been resident in the 3 previous tax years, this table, I appreciate there's probably a lot of letters and numbers going on here, but I'll talk through them now. So the key here is that non-resident is NR and resident is R. So looking at your ties and your individual position indicates how many days that you can spend in the UK. So if you take a really broad example is to say, right, I've really considered about moving to the UK. My family are going to come with me and we're obviously going to have a property. So you would say, well, okay, I'm looking at my position in the UK. I've got 2 ties to the UK. So how many days can I spend without triggering residency? So you would go along your table and go, I've got 2 ties to the UK, so I can spend up to 120 days here in the UK. If you recall on the previous slide, the one downside of this is we have the 90-day tie. So in that example, if you had your 2 ties and you spent 119 days, for example, you wouldn't be resident. But then if your tie stayed the same for the following year, you'd then have an additional tie. So there is some sort of flaws and things that we see in practice on a daily basis where people try to manage their days, but they sometimes inadvertently slip and become resident. If you go into the next slide, please. So in terms of those previous slides, we're looking at the year as a holistic year. So the default position is to say I'm either tax resident or not resident. However, obviously, it's not always practical for individuals to come to the UK on the 6th of April. And therefore, they introduced some provisions where they're effectively called split year. So I suppose it does what it says on the tin. It splits the tax year into two parts, one period of residency and one period of non-residency. So if you're coming from the Ukraine, there's 8 cases that you can consider, but the 5 on screen are the ones that we see for people coming inbound, whereas we have the first 3 cases for people leaving the UK. So the one that we frequently see is normally case 5, so starting to work full time in the UK. So if, for example, you've enjoyed this webinar and you're thinking, yeah, I'm going to come and work in the UK, you negotiate your contract and your prospective employer says to you, right, we want you to start on the 1st of August. What you would have to then do is you'd say, well, that's when I'm physically starting work. That's going to be my first day of UK tax residency. What you have to make sure is in the period prior to that build up is, depending on your ties to the UK, you can then restrict the number of days that you can then come. So if, for example, you have 2 ties to the UK, and on the old schedule, it would replace where we've got on the left-hand axis there of 120 days. If you started in 1st of August, you could spend 50 days here. If you exceeded that 50-day threshold, you would then effectively be tax resident for the full year. So it is really important to seek that sort of advice. And a lot of what I do on a day-to-day basis is pre-arrival planning for individuals to make sure they've got their ducks in a row, and equally for people leaving the UK in a similar vein. If you go on to the next slide, I can show a bit more detail on this. Since 2025, HMRC have introduced a new way for non-domiciled individuals to be taxed in the UK. So we used to have an old system which was called the remittance basis. So the remittance basis effectively meant if you were non-UK domiciled, you could tick a box on the tax return to say all of my foreign income and gains are exempt from UK tax on the assumption that you don't remit them to the UK. However, what they've done is they've introduced this new, what they call the foreign income and gains regime, or the FIG regime. So what this allows is effectively most sources of foreign income and gains for the first 4 years of tax residency are exempt from tax. However, to ensure you get the tax exemption, you need to still report them to HMRC and effectively elect for the fact that you're claiming the FIG exemption. So the default position is you're taxed on everything, and then you need to tell HMRC all of the other income and then tell them claiming the FIG exemption, therefore I've got no tax to pay. This is only applicable for what we consider as qualifying new residents. So it's for people who haven't been here for the last 10 years. So we're seeing a lot of British people who have maybe left the UK a long time ago who are now coming back because they can benefit from this regime. One of the other big changes is that we've now seen is that monies can be remitted to the UK tax-free, whereas under the old remittance basis rules, the whole point of the protection was that you couldn't then remit the monies to the UK, and if you did, there would have been a tax charge on that. As I said, this has to be at a formal claim on your tax return on an annualized basis. One of the downsides of this is it removes the ability to claim our tax-free personal allowance and our tax-free £3,000 CGT annual exemption. So after 4 years of residency, you are then taxed on your worldwide income and gains, as myself, Ben and Divya are here in the UK. So what we're actually seeing is now a lot of people coming to the UK as a sort of key base for the next 4 years, because if you can manage your affairs effectively, you can effectively pay no UK tax for 4 years and then make a decision to go somewhere else. You're probably aware of some of the other sort of tax effective regimes that other countries have, especially within the EU, whereas Italy, for example, where you pay the flat rate of tax, but that's a €200,000 a year charge, whereas in the UK for the first 4 years you wouldn't have that charge. And one of the case studies that I'm going to touch on later today, with some number of examples, you can see how effective this has actually been. I think in terms of a bit of an overview then of our tax system, it is very complicated and the rates do seem high, but this foreign income and gains regime, if done correctly, can be really effective for people looking to come to the UK. I think that brings me to the end of this section. I appreciate it's a bit of a quick fire overview of how complex our tax system is, but I'll pass you back over to Divya to move on to the structuring models that we have in the UK.
Okay, Duncan. Next slide, please. And next slide, please. Thank you. Fantastic. So hopefully you've received an idea of, what corporate tax is, have a deeper understanding of what corporate taxes you need to look into, what personal taxes you need to look into. I know there are a lot of numbers, a lot of different taxes, but you do revisit the slides later and, just familiarize yourself with that. So in terms of the structures that we see, these vary very much depending on the sectors the businesses are operating in, the size of the business or the group they're part of, what are the plans, and what is the purpose of setting up a business in the UK. So very common structures in the UK are the OpCo-HoldCo arrangements, where you have got limited liability companies that are set up. So they are like parent company and a subsidiary set up in the UK. These are very common from a goods and service organizations perspective, because it is actually physical movement of goods. You have solid sort of registrations for VAT and EORI numbers, which allow you to move goods around very easily because you need that registration for customs and things like that. Also very common from a perspective of where PSCs and management control can be outside the UK. So if you've got, a parent company, say in the US, I'm going to use US as an example. So you've got a parent company sitting in the US and they are trading in goods. They want to have 100% subsidiary set up in the UK. They will set up 100% subsidiary in the UK, but management and control is still outside the UK. So they tend to set up a private limited company, both on a holdco and a subco perspective, that allows the dividends to flow through 100% from the UK company to the parent company. Obviously, you have to take into consideration what the taxes in the US are, what the taxes in the UK are, and plan it. And a corporate tax specialist can guide you through setting all of that up. There's the parent with 100% UK subsidiary structure is also very common, where you're investing in the UK simply for properties. Say, for example, you want to invest in a commercial space right bang in the middle of London. You would have a holdco where you would have the fundings going through, and then you have the opco where the property is held. It's all done from a tax planning and tax structuring perspective, and also making sure that there is the asset is held in a different vehicle compared to where the money flows are coming through. Another structure that we tend to see is the LLPs with individuals and corporate partners. I mentioned when I was talking about LLP registration. This is very common when you have venture capitalists and private equity backed businesses, and you have got the money coming in from fund providers or wealthy families, or you have got corporate groups, the likes of Morgan Stanley, investing money into the business, and they want to have separate vehicles as far as their investment model is concerned. They would go down the route of having a general practice, a limited practice. They would also have an LLP vehicle set up in between, and then they have a management company set within the model. The complexities tend to vary very much depending on what the group wants to do and how they want to extract the funds in the future. These are also very common in Ben Carter's part of the world, is where you have a lot of service firms like Crowe or law firms or chartered surveyors, where you've got a handful of people running the show. They tend to set up a limited liability practice because it's individuals who have got something in common and they've got their fair share of profit shares. The LLP structure is also common where you have got traditional partnerships, which it falls under the self-assessment regime, where, say, for example, a Mr. and Mrs. have come together and they're running a small business, and they've now grown the business and go, okay, we want to have a limited liability protection introduced, and we want to convert it from a traditional partnership to LLP. That's where the LLP structure is also very common, so that they have got that protection, and the business is protected as well for their planning from a perspective of exit or from a perspective of, succession. Other complex group structures that we tend to see are holdco companies which sit within, BVI arrangement, Obviously, you've got loads of like sort of different tax havens around the world. A lot of high net worth individuals or even corporate, businesses tend to like sort of invest money via BVI arrangement into, a holding company in the UK, bringing in something similar to what I alluded to before, holding company for a perspective of funds, and then you have an opco. It could either be for investments, various investments and shares or whatnots, and then they have the opco that runs the show from a perspective of the operations or the trade associated with shares or various investments going on. Or it could be for property. This is, again, very common where you have PSC, persons with significant control, individuals sitting, outside UK. Other investment vehicles that are very common, which sit beneath a trust model where you have a family trust mechanism that's been put into place, is a family investment companies, what we call FIC. This is now Duncan's area where we're talking about non-dormant investment planning, supporting high net worth individuals investing into the UK. That's an arrangement where trusts have taxes, but if they have a tax every 10 years, but they also have a family investment company that is set up in between to make sure that that's where the assets are held or the investments are held. The trust versus the holdco arrangement is also common where you have say, for instance, Mr. and Mrs. Sitting in Sweden, or who have got kids operating and studying in the UK, and they want to make sure that they are trying to secure, they are like sort of future from a funds perspective, and they want to have some sort of planning arrangement in place. We see that as a common structure. Next slide, please. Practical cases. Duncan, I believe this is for you. Next slide, please.
Yeah, so on this first practical case, obviously we are using real life examples. So one of our clients who moved here sort of early part in terms of to the UK from Ukraine specifically, who was a university professor, she obviously wanted to get out from Ukraine and into the UK, and there was a job opportunity that arose for her. Her husband stayed in Ukraine. Her son came with her. When we took her on as a client, we looked at her position and we noticed that obviously, as I mentioned earlier, with our statutory residency test, is in that first year that she arrived, she was actually going to be considered as a UK tax resident, and therefore she had the relevant filing requirements to be completed. What we did then with her other advisor is we looked at her position and noticed that actually, because of that timing, she was resident in the UK and resident in the Ukraine. So as Ben mentioned earlier, with the company elements, the individuals have the same principle where you can end up being treaty resident in one country or the other, and you look at your tie breaking factors. In this particular scenario, she'd just come to the UK, her husband was still there, she had a house in the Ukraine, so it was clear that it was in the Ukraine. But obviously from an income tax perspective in the UK, we still had an obligation to report that and let HMRC know, and also provide them with the certificate of residence to confirm that position. But however, she still had a UK tax obligation on the days that she had done working in the UK, because we still had those primary taxing rights. So in terms of on the outcome on this one, obviously with that assistance, we ensured that both of her filings in both countries were done correctly. We worked in tandem as a team. And really, again, as it sort of mentions at the bottom there, is just recently, she's actually now been recognised as a exceptional talent research. And she's eligible to remain in the UK on ongoing period if she wishes to choose so, but her intentions are still to move back to Ukraine. But I thought this was just a really good example to show, how we've helped individuals from the Ukraine and make sure that their tax affairs are in order, but then also, just taking that weight off their shoulders. If you go into the next slide, please. So this one is not a Ukrainian-based one, but it's a live case that I've recently just finished the work on. So sort of moving back towards that FIG regime that I mentioned previously. So a very wealthy Spanish family were looking at moving to the UK because their daughter was looking to study here in the UK. So their whole family were going to move here. So basically what we ended up doing was looking at their entire asset basis to say, okay, right, what's in the UK? What's outside of the UK? How do we structure this before you come to the UK to ensure that everything will qualify under this FIG regime to basically exempt it from UK income taxes? So we sold a few things, we restructured. went down, did it on a line-by-line basis to ensure all of their assets were where they needed to be before they arrived in the UK. Also, because term time was starting in the September, we looked at, okay, right, in year one, if we can restrict some of your days, then actually you might become non-resident for year one, and then we then have that 4-year FIG window for future years. So we got all of those days in order. So we can now actually almost utilize the FIG for 4 and a bit years. So sort of the outcome of this is, you know, by actually doing a proper deep dive, working alongside the client, we came up with a really positive result. You know, they got what they wanted. They can come here for a short-term leave. And as I've mentioned on the bottom there is, you know, we did a quick analysis in terms of, okay, what was the income tax that we actually saved by doing this? And it was about £1 million in year one. So going forward, you know, for the next 4 years, clients are delighted with that outcome. And obviously, you know, they might decide to stay longer, but then they do know the downsides of then staying. But as I said earlier, it's now a great place to really park yourself for the next 3 or 4 years if it's practically possible. Next slide, please. And I think it's going back to Ben.
Yeah, thanks, Duncan. Yeah, so that's a couple of really good examples there of how we can help. And whilst we did help in this case as well, this one's a bit more of a kind of a cautionary tale, touching back on some of those permanent establishment points that I spoke about earlier. So this was a client that we helped. It was a South African partnership, and ultimately they found out that one of their partners had relocated to the UK and was effectively carrying out their normal role whilst in the UK. The partnership itself hadn't been notified, so there was no kind of pre-planning or anything that had been done in advance of this. So ultimately what happened, because this individual was carrying on their normal role, they were a partner in the partnership. So whilst in the UK, they had authority to act on behalf of the partnership. They were concluding contracts regularly, doing business on behalf of the partnership, which meant that a permanent establishment was created in the UK. And the issue with it being a partnership, as Divya touched on earlier, is that as well as the permanent establishment needing to file in the UK, it also meant that all of the partners of this partnership had a UK filing obligation because they now all had UK source income. So what it meant was that the UK permanent establishment needed to prepare calculations each year to determine what the profit was, and then that was filed on a tax return. But it also meant that the partners, and in this instance there was about 120 of them, would also need to file tax returns to declare their share of the permanent establishment profits. So as you can appreciate, that's an awful lot of administration, lots of costs for the initial setup, the ongoing compliance costs, and it was all caused by this one individual who had kind of come over here without taking any advice and notifying the partnership. So we were able to help. We notified HMRC of the position so that the permanent establishment could be registered and the relevant UK profits declared. And we was also able to help by setting up what we call a composite tax return in the UK. Now, essentially, what this is a one tax return, and it enables all of the non-UK resident partners to be included on this one tax return, as opposed to them all needing to file. The main point being that as long as they had no other UK source income, they could be included on this return. We could declare their profits and pay the tax. So ultimately it meant one return for all of these non-resident partners and one payment as opposed to 120. So a really good outcome for the client. And then we also provided some advice moving forward to make sure that there was some good practices in place so they knew where their people were, and also gave them all guidance as to what they should and shouldn't do when they were in other jurisdictions to make sure that this PE issue didn't arise again somewhere else. And once that advice had been provided, we also then helped them to unwind the UK permanent establishment. So there was no longer any filing requirements here in the UK. So just a good example to make sure you are aware of what your people are doing when they're not in the sort of the home jurisdiction, and making sure they don't create any fine obligations or tax obligations when they're doing things somewhere else. I think Divya's got a couple more positive case studies now. So if we pass back to you.
Thanks, Ben. And yeah, it's very easily done, isn't it, Ben, from a perspective of, people moving around and working in all sorts of different jurisdiction. Of a global mobility team here in London have had a lot of cases, especially post-COVID, where people, you tend to like sort of move around for whatever reasons, whether it's, the health, the pandemic, or, situations currently in the UAE and the Gulf states, creating all sorts of PE risks for businesses, but at the same time, also triggering, personal taxes for those individuals because they're overstaying their stay in the UK. But yeah, just things to be mindful of. You do it subconsciously, don't necessarily realize what's happening in the background from a tax legislation perspective. Next slide, please. So Duncan and Ben have obviously touched on individuals' cases and personal tax cases and partnership taxes and case studies around that. I sneakily in the background did check, if there were any questions. And one of the questions was around, do Crowe UK actually help with company formation, LLP formation and branch formation? The answer is a big yes, we do. We have a company secretarial team who can support you with all of your filings from a company secretarial perspective. In the UK, you do not need to have a company secretary appointed at Companies House. The directors, if you're a small company, can do their own filing, and Crowe can do that on behalf of their clients. We cannot perform the role of the directors because we can't be foreseen to be conducting directors' duties. However, the good news is that we have a few handful contacts that we can leverage who are individuals who are providing director services, and we do so for a lot of our clients. So that's the answer on the chat window question, which ties in very nicely with the success story that we've got about a Spanish company who were looking to set up operations in the UK. They had never operated in the UK, so they had no idea of the UK landscape, had no idea of what the challenges were in relation to setting up a bank, what the tax landscape looked like, what they needed to have in place to make sure that they were able to move their goods around. And so Crowe UK, we were able to help them with all of those different registrations. We also supported them with the registration of employing people from a different jurisdiction. In the UK, you need to have a sponsoring license as a company if you're going to be bringing people in from abroad into the UK. So if you've got Spanish or you say Ukrainian talent who you want to leverage, that they come into UK, that they say they're computer technology experts or they're engineering experts, that in the UK that you don't have anybody lined up who understand your business model correctly. They know, but you want to send them over. If they're coming in permanently, they need to have a sponsorship license. So that needs to be bear in mind. So we support them with all of that, including supporting with their day-to-day compliance. And we were able to leverage some of our Spanish-speaking team because we also have other hot desks for different languages within the firm because we're a global firm. We can leverage all sorts of different languages. We've got people within the firm who speak zillions of languages. We've got a dictionary of all of that. So we were able to do that for them as well. So that the outcome was the client was very, very happy. They were able to refer more work to the network. They were able to set up a shop in the UK and then further enhance their operations in, wider jurisdictions. For example, they wanted something in Italy. It's not on this, but I know that they wanted something done equally in Italy. And then we were able to leverage our network and introduce our core colleagues there. Another success story. Next slide, please. This was for a reinsurance group who were very successful in the US, entering into the UK market, trying to replicate their business model. When they approached us, they had no idea how big their operations were going to get. They were like, it's going to be very tiny. Could you please help us with all of the registrations, all of the setup, all of the back office finance, because we don't understand the UK landscape at all. Could you please support us? I was able to hold their hands, do their setup for them, walk them through what needs to be registered at each stage as they grow, because they were going through a growth cycle. within year 1 to year 3, they went from year 1 being a, £500,000 turnover business to suddenly in year 3 about 25 million turnover business. So that's how quickly they grew, and their model was a great success for them. But throughout this, obviously, we supported them through their startup, through their growth, and when they were ready to exit because they were too big for an outsourcing or a BPO function to support them like Crowe, they wanted us to support them in setting up their shop, identify, where would be the best place to have their offices, help them, hire with their talents, help them with the hiring process of the talent, introduce them to the recruiters, introduce them to, like property conveyancers and lawyers and things like that, and also help them register with the FCA because they were in the regulated market. So that's another like sort of corporate example where we were able to help. It gives you a variation of the different types of businesses from a corporate perspective. Ben and Duncan's cases have given you an overarching practical case around, individual situations, and that's pretty much us, I think. If you could just go to the next slide. Yes. Any questions?
Thank you very much. Thank you all for your presentations made, especially for the case study, which is very useful, and it is much better to understand the principles on some looking for some practical issues. So let's start from the questions we see here from in the chart. The first one was asked about, is it difficult to obtain a tax certificate in the UK? Because in some cases it's very necessary, and in some countries, like in Cyprus, for instance, it's pretty difficult to get that. So how does it work in the UK?
Yeah, so I don't mind taking this one. It's a fairly straightforward process. So the company can apply to HMRC. If they're UK resident, they'll get a certificate. It's typically stamped as well by HMRC, so that can then be forwarded on to the relevant jurisdictions. We also have it for partnerships and LLPs as well. They work slightly different in that they are transparent entities, so it's the individuals themselves, it's their residency status that's relevant. But again, we can get those certificates, and again, it will be stamped by HMRC, so they can be then provided on to the relevant authorities that have requested those.
So tax authorities, whether they look into that control or do such kind of control and management tests in order to issue a certificate, again, like in Cyprus, for instance, or just it's going automatically.
Normally, so in our example, we would approach HMRC and say, this is a UK resident company, and therefore they would provide the certificate on that basis. So I wouldn't anticipate there being any issues in that respect.
Okay, thank you so much. Another question, just a few words and more comments regarding this new regime which came instead of non-dom regime, which allows 4 years the exemption of taxation. So does it mean that it also works and the exemption exists in case of the assets which are being transferred into the UK? Because as far as I remember, there was a difference in non-dom regime. The income received abroad was only tax-free in case if it stayed there. It was not transferred.
Yes.
So how
you're
does
allowed
it work? How
yeah,
does
so
it
you're
work
allowed
now?
to obviously now you can now so if it stays as foreign situs, there is some exemptions that don't qualify under FIG, but pretty much 99% of income and capital gains would be exempt from UK tax. But obviously, if you were to, if an asset became UK situs, it would then obviously not qualify for the FIG exemption. So that's why we look at the sort of line by line asset basis to say, right, this will qualify, this will qualify, this won't qualify. What can we do pre-arrival, if anything? And I think as sort of part of that other question is that's focused for new arrivers, but there is some other benefits for people who maybe have lived in the UK before and are thinking of coming back. So if they've claimed a remittance basis in the past, if obviously, because under the old provisions you couldn't remit the money to the UK, what the UK have done is they've introduced a system which is called the temporary repatriation facility. And what this does is it means for the next 2 years, you can basically, the income or gains that you had effectively sheltered under the remittance basis regime, you can remit them to the UK at a favourable tax rate. So for the current year, it's at 12%, and for next year, it's at 15%. But if it was under old remittance basis rules, it could be potentially up to 45%. So that there's sort of the transitional the transitional rules that they've introduced for people who maybe don't qualify for this new FIG regime, but did previously qualify for the remittance basis in the past.
Okay. The only the thing I clearly understood that the taxation rules in the UK and it's very difficult,
Yes.
and the tax rates are high. So the next question is the following: is there any practice of getting so-called tax rulings in the case of any for difficult tax issues or uncertain issues? So tax ruling which issued by the tax authorities.
Yeah, in general, so you could apply for tax clearance on certain things.
Tax clearance, yeah.
Yes, so normally tax clearance normally comes in. If for example you're looking at a transaction, you want to make sure that it's a capital transaction rather than an income tax transaction. You can write and you set out you apply for clearance effectively to confirm that that is the case. In terms of discretion on tax rates as such, I recently did some work in Monaco, and you almost can do it on a case-by-case basis with the tax authorities to almost negotiate a rate. Unfortunately, in the UK, it's a bit more set in stone, and the rates are the rates. Unfortunately, there's not too much sort of flexibility around those, unfortunately.
Okay, thank you so much. Another question: can we get back to the sample you brought and to talk a little bit more about taxation of partnerships? So, as far as we know, the partnerships in the UK are tax transparent, but in the sample you brought in case of the South African partnership, which became not tax resident or was registered for tax purposes in the UK due to the permanent establishment which of one of the partners. Can you please explain for better understanding in that sample you brought whether all the partners became tax or needed to pay taxes on even who stayed outside UK and were remaining South African tax residents, or only that partner who became tax resident? How does it work? And the second part of the question: how does it work in case of pure LLPs, UK tax partnerships? In which cases they could be taxed?
Over to you, Ben.
Thank you. Yeah. So with the first part of your question, so essentially what had happened is the South African partnership had created a UK place of business. So that UK place of business was required to calculate the profits that were made each year. And that's deemed to be UK source income of that South African partnership. Now, obviously, the South African partnership itself can't pay tax. So what it meant was that the income effectively fed through to those individual partners. You had the one that was resident in the UK, so they had to prepare their own individual tax return. But it also meant that all of those other partners had a share of that UK income, and that needed to be reported to the UK tax authorities. So there was a partnership tax return initially, which declared the profits for the UK permanent establishment. And then there was also then the individual tax returns that needed to be dealt with. We do have a facility in the UK, which I mentioned, which is called a composite tax return, which effectively allows for non-resident partners to be included on this one return on the proviso that they have no other UK source income. So if all they had was a share of the profits from this UK permanent establishment, we could include them on the composite return. It then meant that rather than filing roughly 120 individual returns, all of the non-residents could be covered by this one composite filing facility, and the tax due on those UK source profits could also be made in one payment. For those that remained non-UK resident, their profit share from the South African element of the business wasn't taxable in the UK. It was only the UK source profits.
Okay.
And then dealing with your second part of your question, so for UK partnerships or LLPs, again, it works in a very similar way. There'll be an annual tax return that is prepared. On that return, it will confirm the profit share for each of the individual partners. And then it's then those individual partners' responsibility to file that on their own tax return. And HMRC would expect the figures to agree with what has already been reported on the partnership return. And then depending on the individual circumstances, they may have other sources of income as well that would need to be declared. And in that instance, it's the individual partner's responsibility to pay the tax over to HMRC. It's very common in the UK for the partnerships to assist with that process. So, for example, with the partnerships we look after, we will file the partner tax returns, maintain a schedule of the tax payments that are due, and then provide that to the partnership for them to facilitate the payment for the individuals.
Okay, thank you very much. And just to specify, and this tax payment obligation arises in each case or only for that income which was generated by the partnership from the UK sources or through the permanent establishment in the UK?
Right, yeah. So for the example I gave in the case study, it was only the profits for the UK permanent establishment that needed to be declared. The South African portion of the profits didn't need to be reported in the UK.
So the same principle for local partnerships.
Yes.
Okay. So another question regarding and maybe also some success story about bank account opening, which it's very difficult thing for any foreigner who wanted to start a business in a different country at the beginning, having no sufficient substance and business, and the banks became very suspicious about their clients. So does use of any local trustee on the position of the director helps in that? And maybe you have some in your practice samples or success stories.
Yeah, sure. I'll take that. So from a banking perspective, it's always a challenging thing. So success stories, we have been able to sort of advise clients, and it's quite recent case study, so I'll be able to share that. One of our US potential clients who were setting up in the UK, they don't have any UK presence, no UK directors. Individual Mr. and Mrs. had a business in the US, have a very similar model here in the UK where they're investing in a UK subsidiary, don't want a third party for obvious reasons to get involved from a banking perspective. We did leverage our contacts to say that there's somebody who can provide a UK director responsibility, so it's easy for you to open a bank account. They were worried, obviously, that this is a person that we don't necessarily know, so we don't want them on a banking mandate, quite understandingly. So what we did propose to them was two routes. They could either leverage their existing US banking relationship and see whether they can open a GBP denominated bank account in that jurisdiction, with the name of the UK company, because the UK company name is very similar to the US company, or speak to the banking relationship manager to see if they can, refer them to the UK bank manager, and they would be able to expedite things. Quite often it is very challenging, and it's bank to bank, so they weren't very successful behind the doors speaking to the bank manager. They tried to go down the route of opening a bank account online because their initial turnover was going to be below 2 million, so they can't go down the corporate route. They tried 2 high street banks, and obviously it is still in motion because it's been a month, and they do say about 4 to 6 months on KYC, even if the information is very, accessible and available. So in the interim, what they have done is went down the route of using a challenger bank. Now, challenger banks like Revolut don't have very hard KYC or regulated settings. Depending on what country you're in, some countries they're sensitive with, some countries they're okay with, US they were okay with. And because this wasn't a complex structure and it was just a Mr. and Mrs. business in a company, they were able to set it up pronto for them. So the challenger bank account was set up so they could conduct their business. They've started trading. Small amounts are going through their bank account. They're leveraging their bank account from the US to UK remitting funds to try and make sure that the payments are executed and the bank's cleared quickly so there's no risk or exposure from an insurance perspective. Like, obviously, you don't want to be losing money because you're in a challenger bank. They're not as regulated as high street banks. So they've been able to do that. Does that help?
Okay. Thank you so much. And I see we have just a couple of minutes remaining. I have a last question. Just a short advice. What would you recommend to set up the company or a branch of a foreign company in the UK for business purposes? What is according to your opinion, easier to manage, to report, and from the tax perspective also?
So I touched on this before, and it really depends on what you're planning to do in the UK. If you're planning to be here for long term, setting up a business and staying and scaling, then private limited company route is a better option because that offers credibility when you're trying to get any sort of external contracts, properties, any sort of mobile phones that you need for your business or cars that you need for your business or for your employees. There is credibility. There is a credit scoring available for a private limited company. If you're going to be in the UK to test the waters, to say, okay, I'm doing this business in Ukraine. I want to see whether, this is going to be a success story in the UK. I don't know. I could go in for 2 weeks, 3 weeks, maybe a month or a year, and then go out. Then branch is the route. With each model, obviously what you have to bear in mind is how much support is going to be required from Ukraine into this business. So if you're going to be leveraging third-party debt, you're going to be leveraging third-party contracts, then private limited company is better. But if you have all of the financial backing in the Ukraine and you're just testing the waters in the UK, then branch is an easy route. Now, if you're a limited company and if you are of a significant size or part of a group that it is a significant size, additional compliance obligations is audit, which can become a very expensive venture for you. If you are a branch and you really don't care about third-party debt because you have got enough money, you're a high net worth individual, then go down the branch route that saves on the compliance aspect of it, and you don't have to worry about credit rating, credit history, and stuff. Quick registration is limited company. 2-3 days, you will have a company in hand. Branch can take longer. Company winding down is a longer process. So if you enter and suddenly gone in a year, I can't, if you've got third-party liabilities or anything, only contracts outstanding, then that becomes a massive exercise to shut the company down, private limited company. With a branch, you can just cut the cord very quickly. I hope.
Okay, it requires some professional liquidator as far as I remember, no?
Yes, indeed.
Okay, and from the taxation point of view, you mentioned that there is no withholding tax on dividends being paid by a corporation, but what about the payment of the share of profit earned in the UK by the branch to the head office? If there are any difference in taxation with transferring the,
There is, yes. I mean, obviously, if you're a limited liability and if you're generating profits, a private limited company, there's going to be tax payable on that. Yeah. If you're planning to not be taxable, like you have you can't be not taxable because you have to have a cost plus markup arrangement in a limited liability company, even if it's 5%. HMRC, the UK tax authorities would require that. For the shareholders, if it's 100% from a UK company to a parent company, they can take dividends out and pay to the parent company. Now, this is going to be Ben's area to confirm, how that works in terms of tax dividend transfer. From a branch perspective, the branch is also required to do tax filing. There is a requirement here. So if you're going to have a branch set up and you've got 2 people here that you're paying payroll for, there is a cost plus markup if they're generating income arrangement that's going on. You are required to like sort of declare your taxes in the branch as well. So I hope that answers the question. But
if I would like, okay, I've paid the corporate tax on the branch level, but if I would like to transfer the profits, remaining profits, to the head office, would it be considered the same way as for corporation as dividends, and will also be zero taxation exemption on that?
Ben, do you want to take that question? I know the answer, but you're better off.
Okay. Yeah, so typically dividends would be exempt, and there'd be no withholding. I think with the branch, it's obviously a little bit easier because, as you say, you pay the corporation tax, you're then left with a sum, you then pass it back up to head office. With the company route, it becomes slightly more formal in that you then need to declare a dividend and things like that. So
so there is no taxation on that portion. Okay, thank you very much. So I see it's 1 hour and a half. We're right in time. Let me take a look whether any questions remaining. No. I thank you very much again for your time spent. As it was mentioned by the colleagues, this presentation was recorded and will be published on social media and in YouTube. And if there would be any questions, I think you would allow to ask them in writing, or would not be very annoying. Thank you so much. Have a nice weekend and all the best for all of you.
Fantastic. Thank you for having us.
Thank you very much.
And have a lovely weekend, everyone.
Thank you.
Thank you, guys.
Bye-bye.